Hi, my name is Rajiv Rubello, and I'm the principal and actuary of Colva Insurance Services. This is the sixth and final video in our series of how choosing the wrong life insurance policy can be a $21,000 mistake. In this video, we'll go ahead and summarize the risks of purchasing a life insurance policy and offer you tips on how to avoid the life insurance pitfalls I've described in the previous 5 videos in the series. So now let's go ahead and summarize the risks of purchasing life insurance for both term and permanent policies. As we learned in the second video in this series, term policies should be purchased if you have short-term needs or are unable to stay committed to the early year expensive premiums of a permanent policy for your long-term insurance and investment needs. So now let's consider the risks of purchasing term policies, and then we'll move on to the risks of purchasing permanent life insurance policies. The first risk of purchasing term policies is purchasing a long-term policy when you only really have short-term needs. We saw this in the early videos. It doesn't make financial sense to buy an expensive 30-year term product when you really only have short-term needs. When you engage in this behavior, you only end up spending thousands more on premiums for extra life insurance coverage that you don't really need. And because of this, you're more likely to cancel the product completely a few years later. This type of policyholder behavior allows the life insurance company to collect expensive premiums for a long-term product while only having provided life insurance coverage for a cheaper, shorter-term time period. It's the policyholder, then, who ends up getting the worst end of this deal in these cases. The second risk is purchasing a term policy instead of a permanent policy for long-term insurance needs. We saw this in the 5th video, that if you intend on keeping a policy for 20 years or more, you'd really save thousands of dollars, and more likely tens of thousands, by purchasing a permanent policy instead of a long-term term policy because of the tax-deferred cash value accumulation. As we saw in that 5th video, even if you're not interested in the investment side and just want to pay the minimum possible for life insurance, you're still better off getting the permanent policy and structuring it properly, as it will allow you to end up spending thousands less on life insurance premiums over the course of your coverage. The third risk of purchasing a term policy is purchasing more life insurance than you actually really need. Purchasing more life insurance than you need doesn't make a whole lot of sense for a number of reasons. The first is that it's more likely to result in you canceling the policy early once you realize you don't need it, which, as we mentioned previously, just allows the insurance company to charge you expensive premiums while only providing you with a shorter, cheaper protection. The second is that there is a very small percentage that you actually will end up dying during the coverage period and benefiting from the policy. Most people live long lives well into their 80s. Purchasing extra life insurance coverage is just spending thousands on a product that you will most likely never receive the benefit from. You're much better off spending these thousands on something you're more likely to end up using, like a college or retirement savings account. This is why it's very important to understand your needs and how they change over time, and purchase a life insurance product that best matches it. So now let's talk about the risks of purchasing a permanent life insurance policy. The main risks are purchasing a permanent policy when you really only have short-term insurance needs, or when you don't think you'll be able to stay committed to the early year expensive premiums. As we saw in that 5th video, the high life insurance expenses and cancellation charges of these policies in the early years can cause you to lose $21,000 just by purchasing an expensive permanent policy and end up canceling it a few years later. So we saw in this 5th video that if you intend on keeping a policy for 20 years or more, you'd really save thousands of dollars on premiums and more likely tens of thousands by purchasing a permanent policy instead of a long-term policy because of the tax-deferred cash value accumulation. As we saw in that 5th video, even if you're not really interested in the investment side and just want to pay the minimum possible for life insurance to keep it in force for 30 years, in most cases you're still better off getting the permanent policy and structuring it properly, as it will allow you to end up spending thousands less on life insurance premiums over the course of your coverage if done properly. However, when purchasing a permanent insurance policy, it's important you talk with an insurance professional who can help you structure these products and use actuarial features such as shadow account pricing, loans, funding mechanisms in order to maximize your return while minimizing the premiums you pay and your risks. This is exactly what we do here at Colva. We utilize our actuarial expertise in having helped price and design life insurance policies in order to make life insurance companies profitable so that we can help you get the most value from your policies. Most life insurance agencies, on the other hand, are incentivized to maximize their commission at the expense of your risks. The last thing you want to do prior to considering purchasing a permanent life insurance policy is look at the crediting rate of that policy, or in other words, the rate of return on investment. Remember that purchasing a life insurance policy is an investment that requires thousands and often tens of thousands of dollars. Just as you do research on a mutual fund manager before investing thousands of your savings into it, you should do research on this type of policy and the company providing it. The key question you should ask yourself is, what rate of return can I make on this investment? Different companies offer different rates of investment on their products. You want to choose one that not only promises a high return on investment, but also has a history of keeping that promise. Some companies will show you or illustrate one rate of return on investment before you purchase the policy, only to lower their crediting rates a few years later after you've purchased it. In order to avoid this scenario, one of the first things you should ask someone selling you a permanent policy is, has this company ever lowered the crediting rate on any of their permanent life insurance policies? If it has, you should be wary of investing thousands of dollars into a policy that may end up providing you with gains that are a lot lower than you originally expected. So as you can see, life insurance can be a very complicated financial product. In essence, whenever a policyholder is making an insurance decision, he is implicitly playing a betting game with the life insurance company. And most policyholders don't want to think too much about life insurance because, well, it's life insurance, and any kind of insurance is not particularly anything any of us want to spend too much time thinking about. Unfortunately, because of this viewpoint, most policyholders don't put enough time or thought into the process before making their decision. And this ultimately ends up costing them thousands and often tens of thousands of dollars. The insurance company, on the other hand, has spent decades perfecting their strategy with regards to this game. They don't know whether any particular policyholder will be a good player or a bad player. In fact, they know that they will end up losing this game to a few good players. However, more importantly, they know that the overwhelming number of bad players they face will make up for the few losses that they experience. Insurance companies can actually use past experience to predict fairly accurately what these bad players will do. They then use this information to price and design their products and make them profitable. So the qualities that ultimately determine whether someone is a good player or a bad player are education and opportunity. So how do you win at this game? There are a couple of key moves you can make. First, learn as much about life insurance as possible. Talk to educated professionals in the industry who have your best financial interests at heart, and not just their future commissions. This includes financial advisors, CPAs, estate attorneys, and insurance professionals that you know and trust. Second, create a financial plan for yourself. Talk to a trusted financial advisor who can help you create a financial plan for yourself and help you determine how much you need to save each year in order to meet your college savings and retirement goals. As we learned in the third video in this series, creating a financial plan is key to determining your current and future assets and liabilities, and it's just the difference between your liabilities and assets over time that define your life insurance needs. Third, make sure you make a life insurance decision based on need and not emotion. One of the most important concepts I've tried to emphasize in this series is that prospective purchasers of life insurance should understand that their life insurance needs actually decrease over time, and therefore should purchase life insurance based on this. Just because a life insurance agent selling you a policy is a nice guy or a family friend does not mean that he is knowledgeable on these topics. It also doesn't mean that he always has your financial best interest at heart, as his commission is based on how much life insurance you buy. And this is ultimately Colva's message. By educating our clients about how life insurance works and utilizing our actuarial knowledge and expertise, we can help policyholders save thousands in premiums while maximizing the value they receive from their policy. Life insurance is a great product that can protect your family and provide long-term growth and rewards, but only if you understand how to use it to your advantage. Otherwise, it's just going to end up financially harming your family more than helping them. This is why it's very important to get all the right information first. At Colva, we help our clients create a financial plan and properly determine their life insurance needs over time. We then provide them with an insurance solution that better matches their needs and provides them with maximum value while minimizing their risk. Since Colva's message is about education and not commissions, we actively donate 50% of all our commissions to local schools and charitable organizations that help educate or benefit the public at large. Each year we help raise and donate thousands to these organizations. If you want to learn more about COLVA's Educate Our Youth program, or are a school or charitable organization that wants to participate, then please visit our website at www.colvaservices.com/educateouryouth. Well, that concludes our presentation and the last video in our 6-part series on how choosing the wrong life insurance policy can be a $21,000 mistake. I hope you've learned a lot about life insurance, how it works, and will hopefully be able to use the tips you've learned here to make better life insurance decisions in the future. And if you're ever in the market for life insurance, I hope that you'll contact COLVA and find out how we can provide you with a solution that best matches your needs. You can reach us by phone at 1-800-561-4028 or by email at support@colvaservices.com. Also feel free to browse our website at www.colvaservices.com. We have a lot of great information there in case you're interested in learning more about life insurance. Once again, thanks for your time, and I hope to hear from you soon.